Audio Jungle. Audio Jungle.
Our next guest, Eric Dubin. Now, every time Eric comes on the show, he presents analysis that you're never going to get from Bloomberg or Reuters or what I call CNBS or Fox Business News. He's not going to give you any hopium. He's going to give you the facts. And we're going to talk about when Eric was on the show about a year ago, he pointed out, here's where I think the markets are going to go. Here's what we're going to see. And lo and behold, to all those folks on Fox Business News, the Stuart Varneys of the world, and the folks at CNBS, oh, who could have ever foreseen that the stock market would be heading down by this much at this point? And, oh, who could have anticipated? Well, I can tell you one guy who anticipated it and called it, Eric Dubin. A little background on Eric. He had a very interesting background. He has extensive experience as a journalist, an internet media executive, and a financial analyst. He is co-founder of Citizens for Transparent Government, CFTG.org. He can be found on Facebook at Eric Dubin, D-U-B-I-N. Eric, welcome back to Operation Freedom.
Great to be back with you, Dave. Thanks.
Okay, Eric, let's have at it. Let's talk about where we are with the financial markets in the United States and around the world right now. We just went through, we're in the process of going through, as you've pointed out, further correction, but we've gone through a correction. The Stuart Varneys, Fox Business News, CNBS, well, this is, who could have predicted it? Well, you did. Where are we?
Well, I believe we are smack in the start of a bear market within the U.S. equities market and a global downturn in economies worldwide. We have asset bubbles that are now deflating and will continue to deflate. We just touched almost a 20% correction in the S&P 500, and that's what the classic definition of a bear market is. We are just seeing the process of the unwinding of all of the credit largesse that was created over the 2008 and onward period when they rescued the financial system from imploding. We've gone through this cycle over and over and over again since, well, it goes back even further, but certainly by the 1987 crash when Alan Greenspan came in and saw the markets crash in October. He implemented what became known eventually as the Greenspan put. Anytime financial assets would roll over, they would reflate a new bubble to save the previous busted bubble. And each time the bubbles get bigger and bigger and cause more damage each time they blow. And 2008, if you start the clock with Alt-A mortgage financing, it'd be like 2007 when our last crash began to percolate. It takes time for these things to unfold. And the show that you're referencing, I believe it was in mid-February when I was on the show, and I was talking about how we went through really fast decline in January of last year. Mm-hmm. People were really worried about that as being the start of interest rates moving up and crashing the market, and it just takes time. This October through December saw one of the bigger declines in our U.S. equities market, and one of the worst Decembers ever. And we'll stabilize a bit. We're still going through the political circus as well, and as backdrop with the budget and government shutdown and whatnot. But where the rubber really meets the road is where the economy is. And in the United States, I believe we are entering into a recession, even though people are really excited about things like, last Friday's unemployment report being really strong by nominal figures. But that's exactly what you see when you start a recession. We don't have unemployment at the bottom. We have unemployment numbers that look like the economy looks strong. So the Stuart Varneys and all the other talking heads just kind of blab away and miss what's really going on. And this is going to be a multi-phased bear market that'll continue on this year, and we're going to see peak to trough, at least a 30% down move. So, the S&P 500 was at 2,900 and change at its peak this year, and slicing 30% off of that is going to be pretty easy to see over the course of this bear market as it unfolds.
And so the folks on CNBS last week, we've had these market gyrations, down 600, up 400, down 500, up. These are not gyrations that are indicative of a healthy financial markets, are they?
No, and what's interesting is the contrast with the last few years, because we went through an artificial period of many, many years where you could just lay a chart of the S&P 500 on the table and look at it. It was like a 45-degree straight line going, ever up, not much volatility, people in the financial sector as well as the, programmed robotic trading systems and so forth, all basically on one side of the boat, because they assumed that the Federal Reserve and all the central banks would continue to put in credit, and that there was no reason to worry at all about stock markets going down and interest rates remaining tame, and the regular financial system supporting that kind of a worldview. And that blew up huge bubbles everywhere: real estate, arts, debt financing for everything, including corporations putting in trillions of dollars into their own purchases of their stock, elevating the stock market.
And when we've looked at interest, let's look at interest rates as well, because many people say, well, okay. If Eric thinks that the stock market is going to have further decay, further declines, I'll transfer assets into the bond market because stocks are going down, people will look for safe havens and they'll go to the bond market, and interest rates are going to be falling, and so that's where should people do that?
Well, it's wise to have at least some exposure to the bond market, but the thing is that bonds are overvalued as they are, as is, and the normal economic tendency that investors will do is to assume that when a recession is looming, that the bond market is a safe place to hide, and generally speaking, that's true, but we've had such overvaluation that it's not the same father's bond market. We're far from where we used to be. So, the alternative asset space is where the greatest insurance would be, and that is gold and silver, and they have responded very strongly in December and will continue to respond. We've seen basically a bear market in gold and silver since the 2011 peak. We've seen, a lot of recovery periods, but then falling all the way back down, and this is a long cycle rotation where we've had the longest duration equities market move higher and gold and silver punished. And one of the strongest correlations with gold is what the S&P 500 is doing. And as equities continue to fall during the course of this year, and it's not going to be a straight line, we will see precious metals move up.
And you mentioned earlier in this interview about the unemployment numbers that came out this past week. Do you take them legitimately as being legitimate, Eric?
No, they are political and they're massaged. There's a lot of statistical machinations that the Bureau of Labor Statistics uses to basically tweak the numbers per their objectives. We can go through those chapter and verse, but probably make your audience yawn. But suffice it to say, the reality of their massaging has even been pointed out during periods in advance of an election, and the way the birth-death model is used to create jobs that are assumed to be created by the expansion in the economy is one of their levers that they use to manipulate. I mean, the bottom line is that the government could produce real-time jobs data simply by auditing the W-2s and tax returns and withholding that the government is well aware of through the IRS, and get an absolutely near perfect estimation of what is going on in the labor market. But instead they use these statistical machinations, surveys, and they produce data that is just not accurate. I mean, we have a labor force participation rate that shows that we've continued to decline. And the reason why the unemployment numbers look as good as they do is primarily because a huge percentage of the American workforce has dropped out of the workforce, as well as a large percentage taking on multiple part-time jobs. And this started in earnest as well after Obamacare came in, because corporations were trying to keep their books with employees who were only working less than 30 hours a week to avoid, the initial phase of Obamacare. So this changed all of our labor market. The labor market we have today is a very different animal than what it is, combined with how the government tries to measure it.
Well, and in fact, while they were going crazy and having a party on Fox Business News and CNBS on Friday when they announced that, well, the expected number was 184,000 increase in jobs, yet, well, the actual number was 312,000, and all is fantastic. But also the unemployment rate, ticked up from 3.7 to 3.9. And in the household survey, when I looked at it, and tell me if I'm wrong, actually the number of unemployed Americans actually increased.
Yeah, well, this is how these statistical models mesh. They don't always tell the same story. And part of it is, more part-time workers coming in, and one survey is showing one thing and the other not. But they created a lot of business services within the month survey that elevated the numbers, and the birth-death model was a factor as well, too. And, the overall rate of number of people who are employed in the United States is still on a decade-level picture declining. Mm-hmm. The number of people who participate in the labor force is really the most important statistic, and that's been abysmal. It's been falling for over a decade.
Now, as this is played out, and as the correction that we spoke about earlier was playing out, there's several factions here. We have the globalists, if you will, pointing at Trump and saying, oh, it's because of him having these, quote, trade wars with China, with Europe. This is why the stock market, the financial markets are cratering. And then we have President Trump pointing at the Federal Reserve, globalist tentacle, Federal Reserve, saying they're the big problem. They're my biggest enemy. They're every American's biggest enemy. Who's right?
A little bit of both. The primary mover of stock markets is always going to be liquidity. How much money is flowing into the world system, and money always wants to find a home, and usually it's finding it among other places in the stock markets of our world. And liquidity has been curtailed by the Federal Reserve for a couple of years now. They've taken out about $400 billion, which is not a huge amount, even though it sounds like a big number. Their balance sheet was on the order of about $5 trillion. About $5 billion by the time they finished their inflating in the United States. But the central banks are coordinating their efforts, and they have been doing a round-robin inflation of liquidity across the world, where at one point we were upwards of $300 billion worth of liquidity coming into world markets every month. And when you have that kind of liquidity, that's exactly what would produce the kind of markets that are going up on a 45-degree angle like we were talking before. So the markets are reacting to liquidity being withdrawn, or at least the Federal Reserve and the Bank of England, the ECB, Bank of Japan, they're all talking about, less so much the Bank of Japan, but they're all trying to reduce the size of their balance sheets and reduce the amount of liquidity that they put into the markets, and that has factored in pushing up interest rates. And that's what shot the arrow across people's awareness of the markets and started our corrections in the United States in October. And we're going to see more of that. But for the time being, the central bankers, particularly the Fed, is going to be on pause. They're signaling that they're going to do 2 interest rates in this year. I believe they're probably only going to be able to pull off 1, and then it will come most likely in a June FOMC meeting, and then they're just going to let things ride because equity markets will fall and scare policymakers because of how that will trickle down in terms of the wealth effect and slow the economy in the United States.
The chairman of the Federal Reserve, Powell, who President Trump has been at odds with, let's say, had a conference, I believe it was. He was a participant in a conference on Friday, and prior to this, he had spoken more in a hawkish tone, if you will, about interest rates and the like. In the interpretation of Friday's presentation was he had become quite dovish.
Yeah.
What are and many people were saying, oh, well, it looks like the President Trump, him bashing over Powell's head enough, made some headway here. What are the chances, Eric, is that as this market corrects further, as you have predicted, what are the odds that the Federal Reserve doesn't just not raise or pauses? What are the odds that it actually loosens?
Well, I think it will loosen. I mean, initially we are starting a process of the market stabilizing. We had a big bounce on Friday, and I don't see us going down anytime soon. This corrective process and this overall bear market that we are in right now is going to go through many phases. And we just went through the first phase, and we're going to see markets drift down probably in the summer. When the economy is much more clearly declining and people are worried about corporate profits, the economy will lead the market, or rather the markets will lead the economy's decline, but the economy is going to push it, and perceptions are going to change. So I think that the Fed is now talking a softer outlook because they're afraid of what was going on in October through tail end of December in the stock market. And they're afraid of what assets would do as they decline and translate into the economy. So for now, Powell is making nice with Trump, and we will see some stability in the markets, but we are going to also turn down pretty quick because the economy is going to lead that expectations process. And the one thing that I didn't expect quite as clearly as what happened is that interest rates have already hightailed and declined fast. We went up to about 3.25 on the yield for the 10-year U.S. Treasury back in October, and now we're already back down to pretty fast decline. I'm in my chart here, and I can tell you in a second where we are. We went down to about 255. Mm-hmm.
It's a huge
that's a really big move. When you do 70 basis points on the U.S. Treasury 10-year, I mean, that's significant, and it happened only within 2 months. So the shift initially in the stock market was people freaking out about the realization that the Fed and all the other central banks are trying to take away the punch bowl, and that pushed interest rates up. Interest rates have dived down because the Fed and other central banks are trying to balance things, and in particular, the Fed is trying to talk a soft note, and people are also worried about the economy turning down, so the interest rates have declined, and that's what's going to buy us some time in the U.S. equity markets and give us a bit of a bounce. But all these things are going to reassert themselves later this year. The economy is going to be signaling a downturn. People will pay attention to that, and our high levels of debt will always pressurize where the Treasury yields are going to be, and how the dollar even fits into that too as well. I believe we're going to have a dollar crisis later in the year. Decline.
So Eric, let's this particular part I don't think you enjoy, but our listeners do, and I do as well, because you always will provide an answer. Let's look at December of 2019. Tell us where you believe we're going to be, because you're uncanny in your ability to predict these financial markets. Where are we going to be? Stock market, bond market, dollar, gold, silver.
Gosh, so many.
Yes. Well,
I think gold is going to be easily over 1,400 sometime this year, and still silver will be in the 20s. And we're going to. I don't know if it's going to happen this year, but I do believe that the process of our continuing in the U.S. equities market, bear market, is going to continue, and we'll see a correction as well as something that will lead us to testing the S&P 500, 1,800 points, and that will not likely happen all this year, but that this bear market cycle in duration will include a fall of the S&P 500 down to about 1,800. And I think we're also going to see somewhere in this year at least a 20% correction yet again as part of that process. But I don't think we're going to have a 1987 style crash where things just kind of just go crazy and fall within a few days and then correct themselves. The Federal Reserve and all the other central banks have gotten a lot better at being able to manage the monstrosity that they help create. And they soften the swings, but they can't change the nature of markets, and they can't manipulate things forever. Markets do revert to their mean, and they do follow economic cycles, and I think that that's what we're going to see.
Eric, when you look at the financial landscape on your financial Eric Dubin radar screen, what concerns you the most at this point?
The amount of malinvestment that was created by cheap money is so large that it's reshaped the nature of our real economy. The cycle that I spoke about where we fix asset bubbles that bust by blowing bigger bubbles create changes in the overall economy. It even has shaped the way our workforce is. Over time, that hollows out our real economy because it gets financialized. We have way too much paper pushing, way too much unproductive activity based on financial assets as opposed to building long-term economic growth. And markets have always been an intermediary system to be able to facilitate the engine of capitalism. But now we have something that is distorting the nature of what a productive economy is at its very basic fundamental level. The kind of crash that we're going to have is going to potentially be worse than what we saw in 2008-9 because of the size of the bubble that they blew. And what concerns me most is that people are not really understanding what causes these cycles, and they blame the wrong actors. It is, in fact, our policies and the way we have structured our financial systems in relation to our economy and our policies that are the biggest problem. We create our problems that end up hurting a lot of people and not having long-term economic growth. We have way too much paper pushing and financialization, and it's distorting everything.
Eric, how can folks follow you? Because they need to follow you.
Probably the best way at this point would be just to check out Facebook, facebook.com/Eric Dubin. And if people are interested in the work that I do, I'm going to be launching a free newsletter, and they can just drop me an email at eric@ericdubin.com.